Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I found her work about a month ago. And some of my friends went to the Grants Interest Rate Observer Conference in New York City. It's a pretty famous conference. I think it's $5,000 if you pay for a regular ticket to go there. But she was one of the presenters, and that's a big deal. She's a transparency reporter at MarketWatch.com, a Dow Jones publication, where her work is also featured frequently in the Wall Street Journal. She has more than 25 years of experience in consulting, professional services at two of the four big accounting firms, where I think her specialty was in forensic accounting. And she's also now an international business professor in the MBA program at American University. And her website, which is pretty well known and it exposes some fraud, is Read the Auditor. So Francine McKenna, thank you for joining me.
Thanks for asking.
Now, Francine, I want to ask you about your presentation at the Grants Interest Rate Observer Investment Conference earlier in October. So in your presentation, you said, and the slide deck is available for free on your website if our listeners want to go download it and take a look, that you said that over 90% of the S&P 500 companies are now using some form of non-GAAP reporting of their financials. So for our listeners who don't know what GAAP is, can you please give us a definition of GAAP? And also, why do you think GAAP is important? And why do you think that many companies are now veering away from it?
So if you're a company who reports your information to the Securities and Exchange Commission here in the United States because you're listed on an exchange, if you are a private company that seeks to IPO, if you are a private company that just wants to prepare your financial statements according to a standard that's consistent, across companies, industries, sectors, etc., then you have to follow generally accepted accounting principles, GAAP. And that's accounting standards that are developed by the Financial Accounting Standards Board, which is under the supervision of the SEC. And those are consistent, sort of formal accounting rules that companies that want to be listed on any U.S. exchange. And similar rules exist for companies that want to be listed at other exchanges around the world. So you probably heard the term IFRS. That's the International Accounting Standards. And so some companies follow those standards, some companies follow GAAP, but those are the standards so that everybody is looking at the same thing when they're looking at a set of financial statements.
So when I look at the investors' presentations or go through the annual reports of a lot of publicly traded companies now, it seems a lot of companies are avoiding GAAP that are on, the New York Stock Exchange or the NASDAQ. And it seems that they're introducing either pro forma stuff, non-GAAP stuff. And why do you think that they're doing that?
Well, so pro forma is sort of an old-fashioned word, word that's been around forever and ever. And it just means, a forecast, right? A projection based on sort of an internal management numbers. Now, those, they've developed this term called non-GAAP, alternative metrics, non-standard metrics. You're hearing lots of different ways to do that. But the idea is that generally accepted accounting principles, or GAAP, the formal standards, don't meet the needs of companies to tell the story that they really want to tell. So you have accounting standards, right? And they're very technical and they're very formal and they have a lot of, ins and outs, and you have to be an accountant to understand them, especially for a large multinational. And so when companies want to report their earnings, they want to tell the story the way they want to tell it. They don't want to have to explain things that are purely accounting requirements, such as write-offs of impairment of goodwill, or issues around, certain special things related to purchases or acquisitions, or other kinds of, technical issues that they think in many cases distort the picture or don't tell the story of the true trends of the companies. And so what's developed is are these alternative metrics. So you hear even terms like EBITDA. EBITDA is an alternative metric. That's not a GAAP term. That's not something that you'll see on a set of financial statements that are required to be filed with the SEC each quarter and each year. That's all extra. And it's extra because companies have said, well, I want to show my earnings, but I don't want to show interest and taxes and amortization and depreciation because those are non-cash expenses, or those are expenses that are not operating earnings. And I want to show like a pure operating earnings. Okay, so there's all kinds of adjustments, and companies make up the various metrics according to the adjustments that they think are necessary to tell a different story, a better story about what their investors should be looking at for that particular company and the results. And they're moving towards that because basically, they want to tell their own story. They don't want to tell the story that the financial accounting standards force you to tell. A good example is this quarter, Warren Buffett had to report this astronomical amount of earnings because there's a new rule that says you have to report unrealized gains and losses in your investment portfolio in earnings. You have to actually post that to earnings. So he has a huge investment portfolio, and you're going to see lots of, ups and downs. It's going to be a roller coaster. He doesn't like that because he likes to report what he wants to report. He doesn't want investors to really focus on the ups and downs of the shares that he owns in his portfolio. He wants you to just look and say, he's a long-term investor. Just, trust me. And so they reported information that was without those numbers and with those numbers. You have to report the GAAP, but companies are sort of redirecting focus to the numbers without the things that they think are, not telling the story that they want to tell.
I think it's fair to report both of those numbers, like you said. Now, if they would have just chosen one, right, and picked which one's the best one, right, and picked that one, then that would have been, I guess, more misleading.
Well, there's actual rules that say that you cannot put the non-GAAP numbers more prominent in your earnings release. You cannot put them in your Qs or your Ks, except in certain limited circumstances. And you can put performance metrics, but you can't put numbers that are your own accounting in the Q or the K. But in the earnings release and on the conference calls, and when companies talk about their results in an informal basis at a conference, they'll often quote numbers that are these adjusted metrics because that's the story that they want to tell.
So that's an important distinction then. So the real numbers, the stuff that maybe is not spun or stretched, is in the Qs or the Ks, the SEC filings then.
Exactly. And that was one of the points that I was trying to make at the Grants Conference. Jim Grant asked me to talk about the fact that, we're losing the focus on fundamental investing. We're losing the focus on what's really in the Qs and the Ks. So much focus on the earnings releases, so much focus on what companies report for earnings, and then people walk away and the stock moves on that information, but nobody goes back and looks to see, well, how does that reconcile with what the financial statements really say? I'm listening to all the sort of rhetoric that the executives want me to hear. I'm looking at, an earnings release that emphasizes what they want to tell me, but what do the numbers really say? And the point of the financial statements is that it represents the information consistently, quarter to quarter. It, has lots of footnotes and explanations. You can compare from one period to another, and it's all done in the same way, according to the same rules across companies in the same industry, across industries, and across geographies.
So I see EBITDA, earnings before interest, taxes, depreciation, amortization. I see it like basically pasted everywhere. Companies are bought and sold on EBITDA multiples.
Mm-hmm.
What do you think then about Sarbanes-Oxley? Because wasn't Sarbanes-Oxley supposed to fix a lot of this?
Well, Sarbanes-Oxley was a reaction to Enron, a reaction to Arthur Andersen's failures with regard to Enron, and also sort of a reaction to some of the other accounting frauds that had occurred before, after, during, around the same time, like Health South and some of the other big WorldCom, some of the other big accounting frauds that had occurred. And the idea was twofold. One was that companies were supposed to be a lot more focused on their internal controls. So the idea that companies were supposed to develop documentation and testing of internal controls around financial reporting. Let's look and see whether or not we have good segregation of duties. We don't have the same person doing the bank reconciliation as paying the bills and depositing the money in the bank. We don't have the same person paying the bills and also setting up the vendors. We don't have the same person approving the journal entries as looking at whether or not the accounts are correct. So basic controls within larger companies that say, we were pretty sure that we've got enough people and they're good enough at what they do that we're going to avoid the risk of fraud. And then auditors were going to come in and test those controls and give an opinion on those controls. And that was new. In addition, you had this concern about the auditors themselves. So Arthur Andersen was, too focused, according to the critics, on all of the revenue they were getting from Enron on the consulting side and on the tax side. And they had basically given away the audit. They had, rolled over on any concerns about the audit. They had let Enron do whatever they wanted to about all of the off-balance sheet transactions. And the idea was, let's reinstill confidence in the audit firms. Let's set up some, rules about how much consulting work they can do. So there was a new list of services that auditors couldn't do for their audit clients, like develop and implement their financial accounting systems, because then they would be coming back in and auditing their own work. They couldn't be doing a lot of consulting around valuations or acting as the company's broker-dealer or investment bank, things that would generate conflicts of interest. That was the idea. And the idea was that put those two things together would hopefully inhibit corporate fraud, would inhibit executives from committing fraud, would help auditors catch fraud, would help everybody within the corporation sort of be on their toes a little bit more. And the perception is that it worked. But this particular thing about companies using alternative metrics or trying to tell a different story is really sort of a way around the fact that some of that did work. So the way the financial statements are prepared, the controls around preparing the financial statements and the audit is a little bit more controlled. And so companies are trying to figure out, well, how do I manipulate my results if all of this stuff is more controlled? I need to, meet my analysts' expectations. I need to keep pushing revenues up, X percentage every quarter. I need to have earnings growing. And what if real life intrudes? What do I do? Well, when the real numbers don't align for your purpose, when they don't meet your needs, you make up alternative numbers. And that's really the reason why these alternative metrics have proliferated, is because companies had a lot less wiggle room post Sarbanes-Oxley to manipulate the actual GAAP financial information. And that's being audited more closely. And they just can't do what they used to do, build cookie jars of reserves, or do things that like channel stuffing and other kinds of techniques that were more prevalent in the past. That still happens because there are companies that are uncontrolled no matter what you do. But in general, you have the financial earnings are what they are. So how does a company that wants to grow despite the fact that their financial results aren't showing that, or wants to keep increasing its share price despite the fact that its earnings are not supporting that. How do they do that? Well, they tell a different story. Don't worry about this, don't worry about that, don't count this, don't count that. And as the expectations of the investing public grow, as analysts keep pushing them to perform, they keep making up new metrics to sort of meet that expectation. So one of the things I mentioned at Grants was that there was an academic study that said that the actual beats, how much companies were beating analysts' expectations was getting wider and wider and wider. Why? Because just meeting expectations or beating it by a penny doesn't do it anymore. Okay, it's not enough of a drug. You're not going to move your stock. You got to beat it by more. And so the amount that companies feel pressured to beat expectations by has increased, and they look for new techniques, such as trying to find ways to tell a different story.
So, Francine, this different story, is this a legal gray area? Is this technically legal, or is it stretching the truth all the way to accounting fraud? Or are there actually lots of companies committing like what would be called accounting fraud, but maybe the regulators aren't going after them then?
Well, in strictly speaking, alternative metrics are supposed to tell a story when something happens in the company, some accounting situation occurs that's sort of a one-time only anomaly. So if you have something that happens because of, let's say, tax reform, or because you acquire a company and it's a temporary blip, it's not unreasonable to say, we want you to look at the numbers without that sort of anomaly or temporary change in our trend. And we want to, show you information that eliminates sort of that static, so that you can, build models and analyze the company without sort of that noise that's just a temporary situation. However, companies that change their metrics every quarter in order to accommodate the fact that they can't keep up with all of the things that are hitting them, companies that don't follow the rules about not emphasizing these alternative metrics in place of the actual true accounting numbers, companies that abuse the privilege of using these metrics and stretch the definitions. And there are definitions for the primary ones that most companies use, what the SEC has said is expected or within allowable bounds. But, it's a whack-a-mole game, because the SEC, has to look, has to see a situation occur, has to see somebody really pushing the envelope in order to try to come back and say, you need to rein it in. And they write letters constantly to companies telling them that they're pushing the envelope and they need to rein it in. It occasionally, though, does move into the fraud category, especially when they're manipulating these metrics and incorporating them into compensation schemes.
Now, I have a lot of contacts. I know you do too, but I have a lot of contacts in the financial industry, successful money managers, hedge fund guys, portfolio managers, mutual fund managers, etc. And some of the stuff they told me, you said changing the definitions, changing the metrics. Tesla Motors is one of the worst cases. A number of my contacts have told me that it's the most egregious examples of changing the metrics they've seen since Enron.
Well, they had an episode in the past where they went through a series of, lots of letters back and forth with the SEC. And the SEC finally, had to tell them, you're not getting the memo. We told you you can't do this anymore. So some companies will be very aggressive in debating these things with the SEC, and they'll go back and forth, back and forth, back and forth. Usually the SEC will say, it's time for you to, just do it. Sometimes they back off because they make a good rationale. A company like GE had a bad episode with the SEC recently on that, where they were presenting like 6 or 7 different EPS numbers for every single business unit, for multiple steps in terms of going from the true EPS number down to some, adjusted EPS number. And the problem is that you look at the earnings release, or the journalists are trying to report this out, on earnings day, before the market opens, and you can't figure out what in the world is the right number. And you can't, figure out what number is supposed to be compared to the same period last year, because they've changed it up so many times that the information is not comparable. And that's where the SEC will step in and say, time out, this, you're abusing the privilege, and they'll usually work through letters. Sometimes when a company is, again, doing these things in order to try to really mislead investors, in particular, if you have specific executives that are doing this in order to benefit personally via stock options or the shares that they own, then there have been enforcement actions against them, both civil and criminal enforcement actions.
Yeah, I'm friends with Charles Ortel. I'm not sure if you're familiar with him, but he was warning people prior to the 2008 financial crisis that General Electric, General Motors, the large Wall Street banks, and the retail banks, the investment banks, all had really, really, let's just say, aggressive accounting, that they were doing financial engineering and that there would be problems. So you mentioned adjusted earnings, and I see that a lot now. So for listeners out there, if they see the phrase adjusted earnings, should that be a red flag to them? Or is there legitimate cases where, it's a one-time deal, the company discloses it in the footnotes that they're taking an adjustment and it's a legitimate excuse, but would it be a red flag then if we see adjusted earnings then all the time?
A red flag, saying it's a red flag is maybe a bit too much, because there is acceptable use of these metrics. But if you see a company every quarter redefining its adjusted earnings metric, that's a red flag, because what they're doing is they're picking and choosing. They're basically, looking at the menu each quarter and saying, okay, how do we want to define it this quarter for the best, in order to put the best color on it. If you see that the metric seems to be specifically defined so that they can use it for compensation purposes only. So I talked at Grants about a case at Symantec, which is now developed into a class action lawsuit. And I just saw recently that they have decided that their executives are going to forego bonuses for next year and some incentive compensation for this year. Why? Because they had developed an alternative metric related to some of their acquisitions in order to use write-offs that they had to make per GAAP and add them back in for compensation purposes. So they developed a metric that added back in numbers that they had to write off permanently for their actual accounting, and they were paying themselves on that basis. And there was absolutely no rules, regulations, or constraints on that. It was totally arbitrary. If they needed to meet a target, they had a cookie jar that they could add something back in. So that was a story that we wrote, and now there's a class action lawsuit against the company and two executives. And there was recently some additional action with regard to the SEC on what they're going to do with regard to the compensation that they had been paid in the past and how they're going to pay themselves going forward.
And you have a marijuana stock that you have done extensive research on with accounting problems on your Market Watch article column. So you've been covering that company, and I think it just got delisted, right? Because there was egregious accounting fraud there?
So IGC, India Globalization Capital, this was a stock that came to the attention of some of the reporters in New York. Why? Because, everybody is pivoting from crypto to cannabis. And then cannabis, the CBD drinks, the THC-laced, beverages. And so you get this, bubble of stocks that all of a sudden start going crazy because they're putting out press releases and announcements and saying, they're pivoting to this new thing. And everybody chases after that thinking, it's going to be volatile for a while, or it's going to go up, or, there's all these positive announcements about new business areas that they're getting into. This was a company that had been around started as a blank check company, which is basically like a shell. They just, listed, and they had no assets and no revenue. And then they were going to acquire real estate in India and Southeast Asia. They were getting into, some basic manufacturing kind of partnerships. And they went along like that for about 10 years until recently. That's just too boring. And the stock just sort of doesn't go anywhere, and it wasn't doing enough for the executives that were involved. And they decided to, start pumping the stock based on involvement in cannabis-related drugs. So they started putting out press releases about developing drugs related to Alzheimer's and Parkinson's. And in the end, when we started looking at it, there was no there. The research really didn't have any basis. The organizations they said they were partnering with, were really not as aware of them as they purported it to be. You had a number of different issues in terms of how they were doing business, people that they were doing business with, paying to promote the stock. There was a company that the SEC just charged with running paid promotions without disclosing it. And that company, See-Through Equity LLC, had been paid by this company, IGC, also. So when the SEC complaint came out, all of a sudden we see, this company, IGC, is on their list. No kidding. This is the kind of company it is, okay? It's generating hype in order to pump the stock. And it went through a period, late September, early October, where the stock went up like 300% on some announcements related to CBD drinks. And at that point, the reporters in New York said, this is like nuts. We need to look a little deeper. And that's when we did a story called 10 Red Flags that basically said, here's at least 10 things that, all point to sort of the microcap cannabis, fraud alert kind of stuff that the SEC is putting out all the time now, warning people of, the dangers of jumping on the bandwagon in these companies that, all they're doing is really just taking advantage of social media and, quick and easy press releases to pump the stock, but there's really no substance behind it. The company had not issued financial statements or held annual meetings for a while. It was, constantly getting letters from the SEC, constantly turning over its staff and officers. And then it had an accounting firm from India, even though the headquarters was in Bethesda, Maryland. It had an accounting firm that was based in India who had also been the accounting firm for a real fraud, Longfin. And so when you see those kinds of things, you go, okay, this person is associating in many different aspects of its organization with people that are known to be associated or to be a fraud themselves.
So I've also heard of situations where people go like auditor shopping, where they're not going to the local big accounting firm to do their tax auditing and their controls and stuff, and they're intentionally shopping. Like Bernie Madoff actually went to a tiny little branch right in Long Island when he was in New York City and owned a big building. So he was auditor shopping selectively for the right auditor who would give him the financials that he wanted, the sign off, the approval.
Yeah, he had a distinct advantage because he was just an investment firm, and the reason why he needed audited financial statements is just to prove to others that he had somebody signing off on an audit opinion. But he wasn't filing things with the SEC in the same way that a public company is. But even these small microcap companies, if they want to be on NASDAQ or they want to be on NYSE American, which is where IGC was, if they want to be on an exchange and they want to appear legitimate, They need to find an accounting firm that's registered with the new audit regulator that was put in place after Sarbanes-Oxley. They have to have an auditor who is potentially going to get inspected by that regulator. They need to have, a legitimate auditor. However, there's a lot of small, tiny firms who meet those criteria and, also may be more flexible than, let's say, one of the big four. That's not to say that one of the larger global audit firms would not be also flexible under the right circumstances. Certainly, they've been involved in many, 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 many frauds, even in recent times, and since Sarbanes-Oxley. Why? Because it comes down to the individual partner and the individual teams. Sometimes it's a deliberate effort to kind of, please the client, and other times it's just basic negligence.
So I want to talk about the regulators now, and what we can debate if you think it's fair to criticize the SEC or some of the other regulators, because I know there's laws on the books for accounting fraud, but famous value investors and short sellers, David Einhorn, I think even wrote a book about this one company about 10 years ago that was committing accounting fraud, and he took a collection of all his old investment newsletters, laid out the case, and I know he turned the research over to the regulators, and I don't think they busted the company. And so, I'm friends with some of these short sellers now that are friends with Marco Hodes or friends with David Einhorn, and I just hear stories where like these guys, they want to do the right thing. They want to blow the whistle. They send the research over to the regulators, proving that in their opinion, that there is accounting fraud. And then, they don't hear anything back from the regulators, or the regulators say that they don't have the time or resources to look into it. And then, nothing is done. So do you think it's fair then to criticize the SEC and some of these other regulators for not going after more of these publicly traded companies for either pushing the limit too much or actually blatantly committing accounting fraud?
Well, I definitely believe that there's plenty of rules. There's plenty of standards. There are plenty of expectations on the part of auditors and everybody who's involved in the whole ecosystem of producing a company's financial results, including at IPO time. And it all comes down to enforcement. And the problem is that enforcement ebbs and flows. So you have sort of these, hot periods like the .com era, even before that, the savings and loan scandals. Then you have the Enron period. Then you have the financial crisis. And you have sort of this, oh gosh, there's a new thing, and now we're going to focus on this. And they focus on it for a little while, and they make a bunch of big cases. And then they say, problem solved. And so there's sort of a level of complacency right now about corporate fraud, because there's this view that Sarbanes-Oxley solved corporate fraud, that the things that we were talking about before, adding internal controls, opinions, and those kinds of testing and documentation has helped, that sort of the whole atmosphere has changed and corporations are less prone to fraud. However, frauds are still happening every single day. And the idea is that corporations are finding other ways to accomplish their objectives, and the SEC and the audit regulator have to get more savvy every day in order to figure it out. This particular SEC seems to be very focused on retail fraud. They're very focused on helping the retail investor, the small investor, avoid getting caught up in Ponzi schemes or get taken advantage of by microcap fraudsters. However, there's so much of it. And so what happens when you have too much, given the resources? You pick and choose. And so you'll have, those complaints come through all the time. I mean, I get people sending me information about what they think might be a fraud all the time. And as a reporter, just like as a regulator, you look and you say, okay, is this something that I can tackle? Do I have the resources to tackle it? Do I think it's, one of the worst cases that I've seen? As a reporter, I have to look at the profile. Is it about a public company? I only write about public companies. At the SEC, they have to look and say, what's the jurisdiction? How much effort will this take in order to prosecute? Is there something that we can use this case for in order to make an example? So I was at a conference the other day, and the SEC enforcement person that spoke said that every case that they're doing right now related to crypto and ICOs is a message case. In other words, it's a new area. They're concerned about the impact. The rules are very, very, not formed yet. And so they're looking for cases where they can use the case to send a message about what's expected and what's not expected. But if you look and say, well, there's a whole bunch of crypto stuff that is questionable, or there's a whole bunch of ICO stuff that might be questionable. There's even groups of people that are putting out multiple crypto or ICO related, token related kinds of situations where you might say, just grab the whole bunch of them, right? Except that the SEC has to make a decision about where do they put their resources. And, is that going to make the point that they want to make? Is this a good example? Is this something they're going to get a lot of bang for the buck out of if they devote the time? They don't think that big corporate frauds are a problem anymore, though. They think that companies are in better shape than they've ever been. I don't agree. And so therefore, they're putting less resources in that area and more resources in some of these areas where they think they can make a big impact.
Yeah, I don't agree either. So I agree with you, Francine. I think the companies are not in good shape. I think it's an illusion. If you look at a lot of these companies, and GE is a good case study. I mean, for years, GE was doing financial engineering, right? They were loading the debt with balance sheet, the balance sheet with debt. I must have said it in reverse there. They were loading the balance sheet with debt, doing tons of these share buybacks, and that was boosting earnings per share. And then they were using lobbyists to never pay corporate taxes. And finally, all this financial engineering has caught up to them.
Well, if you look at GE, though, I wrote a story that said, if anybody had been really looking at GE, they would not be surprised that all this is going to catch up with them. They've been accounting, malcontent for a long time. But they've also had many sanctions against them and paid fines. And their auditor has been a part of that process, even though they've been their auditor for 100 years. So they've been sued by the SEC and the DOJ. They've had people pay criminal level fines for some of the stuff that they've done in GE. They've had one thing after another. They're a recidivist. And yet they were allowed to continue to stay in business and just pay the fines. And that's what happened with all the banks after the crisis. When you said, crisis, was the crisis even about fraud? Well, yes, of course the crisis was about fraud. You had a lot of mortgage fraud. And 5 years later, they started paying those fines, but everybody forgot that it was related to the crisis. And the banks had reserved for those fines, and they paid them, and they keep going. And then you had LIBOR. And then you had issues like at JP Morgan, the whale situation, which was a huge fraud. But they pick it off one by one, and they time it so that, they can pay the fines and, they can manage how that's going to show up. They save for the litigation, save up, with reserves for the litigation, and they space it out. And you've had, banks like Deutsche Bank or banks like JP Morgan or Citigroup that have had one thing after another and are still having one thing after another, where you have traders that are getting caught on tape, talking about, things like spoofing or things like, dumping or manipulating share prices. This is the thing. They're very nervous. The SEC is very nervous in particular about affecting, the economy, just like they were during the crisis. This was the reason why they had the decision they had with Elon Musk related to Tesla. It's very explicit in the decision. The chairman of the SEC admitted it in his remarks. He said we had to weigh the penalty for the company and for Elon Musk against the idea of damaging the company too much and affecting the fortunes of its shareholders.
So the SEC doesn't want to be the scapegoat then if Tesla does ultimately go bankrupt then. They don't want to be the main reason.
Exactly. It just like the auditors never issue a going concern warning unless the company's already dead. Okay, because they don't want to be,
Thanks for the help. Yeah.
they don't want to be the ones to put the nail in the coffin. Because if you issue a going concern warning, if you give the opinion that the company doesn't have enough, resources to pay its bills for the next year, you've basically rung the death bell. And you're going to have, violations of their debt covenants, and it's going to be a self-fulfilling prophecy. And you turn around and you say, but for the auditors giving that opinion, we would have been able to keep going. Well, yes, no, maybe, whatever. But the point is that nobody warned the investors, at least not in enough time.
Yeah. And also to add to your point there about the banks, I mean, how many banking executives actually went to jail for the fraud?
Right.
So it was all like a handful of little guys, right, at the bottom.
Well, when I started writing about the financial crisis, when I started writing period in 2006, I started seeing the mortgage originators like New Century that started having trouble. American Home. There was another one, Star or something. And you started seeing the mortgage originators having trouble. And you looked and you said, there's something wrong with this picture. And I would ask people, well, where are the auditors? And they would say, well, this has nothing to do with, the auditor. This is like business decisions. This is economic. This is mortgage, and they would make up all kinds of other high level, macro reasons why, this was a tough business to be in right now. And I'd say, no, they're actually, stuffing these securities with, mortgages that don't meet the criteria, and they're going to have buybacks required, and they're not reserving for that. And so all of those things sort of started to flush out, but I had many people telling me, you're focused on the wrong thing. The auditors don't have anything to do with this. This issue is not about fraud. This is not Enron. This is about a cataclysmic, economic event, black swan. Nobody could have possibly anticipated it. And, there's nothing you can do except weather the storm, because it's an economic cycle. And I'm like, no, I don't think so.
So did anyone actually, from the mortgage-backed securities who are stuffing who are lying to the rating agencies and stuffing bad stuff in there, did anyone actually go to prison for that fraud?
There were some smaller players, and you'll still see, TARP is still in existence, and they're still, prosecuting people for mortgage fraud related to use of TARP funds or inappropriate use of TARP funds. There were, and then I followed the case of Colonial Bank and Taylor Bean Whitaker. Taylor Bean Whitaker was a mortgage originator, and Colonial Bank was a bank that was funding warehouse loans for this mortgage originator. And there was a massive fraud that ended up with several people going to jail because basically they were faking the mortgages. And the fraud wasn't identified at either institution by the auditors in place, Deloitte at Taylor Bean Whitaker and PwC at Colonial Bank. And therefore, you had both of them sued by a bankruptcy trustee because both organizations went bankrupt. And in the case of Colonial Bank, the FDIC was the receiver. And they sued the auditors for not finding the fraud. In the case of Colonial Bank, the FDIC sued PwC as the auditor, and just recently won a very significant judgment where, after a trial, which again is very unusual and was very unusual in terms of any of the actions against the auditors related to any of the crisis failures like Bear Stearns or Lehman or any of the Washington Mutual, any of the institutions that had significant litigation after the crisis. The auditors settled very quickly and got away with very, very little damage. But in this case, this one went on, and it was crisis related. It was crisis era. And just recently, okay, what is it now? 7 years later, I think both banks failed in 2009. So almost 9 years later, finally, after a trial, a judge finds PwC negligent for not identifying the risks and performing the procedures to mitigate the risk of material misstatement due to fraud. There was an active fraud. Executives went to jail. they not only missed it, but they didn't do the kinds of things according to the standards that they're supposed to do in order to find the fraud. And the award to the FDIC was the largest ever award ever against an auditor for anything, $625 million.
And meanwhile, you said it took 9 years, but the guy on Main Street, the little guy, they're left holding the bag. It seems like the guy on Main Street, the little guy, the retail investor, is left holding the bag in a lot of these situations.
Right. I mean, both of those institutions, Taylor Bean and Colonial, went bankrupt. All of their employees obviously lost the job, all the employees that didn't go to jail. And they were both public companies where you had shareholders and bondholders who lost. And economic impact. Colonial Bank was in Alabama, and Taylor Bean and Whitaker was in Florida. So you had economic impact to the community of losing that institution, and of reputational harm to the business community, given all of the interrelationships that entities of that size. Colonial Bank was like one of the 25 largest banks in the United States. I mean, you don't even know the name, right? But it was pretty big. Lots and lots of collateral damage. It took this long. An auditor is going to pay $625 million, but PwC has still, survived and thrived after that issue and all the other issues that they faced during the crisis. For example, they were the auditor of AIG, they were the auditor of Goldman Sachs, auditor of JP Morgan, auditor of Bank of America, auditor of several other banks in Europe, Northern Rock. No worse for wear.
So I have a number of other questions to ask you. I'll just ask you two more before we wrap things up. So I've interviewed a lot of famous investors over the years, read a lot of investing books, spoken with my contacts and emails about investing to learn more. And they've told me that one of the ways to look in the financial statements about the health of a company is through the operating cash flow and the free cash flow. So what are your views on this? Do you think that that's one of the best ways to free cash flow and operating cash flow are very difficult to fudge, to fake, to do accounting fraud with? And does the free cash flow number, is that like one of the best signs of the health of a company?
Well, certainly looking at the cash flow statement is a really good exercise. You'll see a lot that you won't see easily in any of the other financial statements. You're going to see specific transactions. You're going to look and see, sources of cash, uses of cash, and you might see information or lines that describe transactions that, again, are part of a larger whole in the financial statements, and that you're going to say, this is a question I need to ask, or this is something I need to look a little bit more about, especially with regard to compensation or, investments in subsidiaries or other kinds of odd ins and outs and odds. So you're going to see the flow from quarter to quarter if you're looking at the cash flow statement. Free cash flow is kind of quirky in that free cash flow is a good metric. Okay, it's a good metric if a company sticks to a consistent definition of free cash flow. But free cash flow, again, is one of those alternative metrics that doesn't have a firm definition. So you'll see as many definitions of free cash flow across companies and even sometimes within the same company over a period of time. So it's important that if you're using free cash flow as a guide to the health of the company, that you make sure you understand how they define it. You look to see whether or not that's a standard definition or at least comparable to other companies in the industry. And you look to see whether or not the company is consistent in how they're defining free cash flow over time.
I think that's good advice there for our listeners to go out and learn how to do that. I mean, the standard definition of free cash flow is just operating cash flow minus the maintenance CapEx. So Seth Klarman in Margin of Safety, he wrote there's a distinction between like growth CapEx and then maintenance CapEx. So some people, though, add depreciation into the operating cash flow number.
Right. And depending on the industry, you have different definitions of what's included in CapEx. And you've got, again, these anomalies from quarter to quarter when some kind of special transactions occur. So I remember seeing, writing a couple of stories about the abuse of free cash flow terminology in REITs. Free cash flow was a term that Tesla was sort of focusing on for a long time, and they still do. Companies that aren't making any money that aren't posting profits like to focus on free cash flow. And you can imagine why, right? Because that's all they get to talk about.
Yeah, I mean, they're going to fool some people, but if you can't make any money, I don't know how you can make free cash flow. So that sounds like a bad sales job.
Well, Amazon hasn't made money consistently for many, many years, and their stock price keeps going up. And they still want to talk about free cash flow because the excuse for not sometimes posting a profit is that they're reinvesting in the business. Well, okay. At some point, the definition of actually running a company is creating return for your investors and for the rest of the stakeholders in the business. And if all you're doing is avoiding taxes and paying out high compensation, well, I think that, your return on investment is a little bit self-interested.
Good point. And the high compensation is not going to the employees, most of them. It's just going to upper management and the executives.
Right. A very limited in more and more complex ways.
So last question before I let you go. So there was a documentary that came out earlier this year called The China Hustle. It was about these reverse mergers, the shell companies. And I don't really think a lot of these people who are selling these shares of these reverse merger Chinese companies, a lot of people didn't go to prison. Some of these investors lost hundreds of thousands or millions of dollars. The share prices totally collapsed. I think a lot of these stocks are still live around $1. They haven't been delisted yet. But what are your views on this?
So I wrote a lot about a lot of the reverse mergers, in particular, again, from the audit perspective. Where were the auditors when these Chinese companies would come here and look for a shell that they could reverse merge into in order to avoid the scrutiny of a traditional IPO process? And then the companies would just sort of take advantage, as many of the companies are doing now in the crypto and the cannabis environment. They would just pivot from one thing to another. Sometimes the Chinese companies were staying and continuing to do whatever they were doing in China. The problem was it was inscrutable. Okay, you're talking about something that's happening in China. You have no way of actually kicking the tires on that. The companies were saying there is absolutely no recourse to sue us because you're going to have to sue us in China, and that's not going to work. Try to find us. And so you had people investing in these companies just because they were small enough cap and they had enough volatility to be exciting to a certain group of traders. And you had people, saying whatever they wanted to say on the earnings releases, again, because there was no way to actually scrutinize it. And the auditors were in some cases compromised or going through the process, going through the motions for the sake of the fee. The thing is that you may not have, China doing this now, but you still have a lot of people doing reverse mergers, and you still have companies that are taking advantage of the same techniques to sort of ride the wave for as long as possible, in particular by pivoting to whatever is the latest hot thing. And you have sometimes inscrutable financial statements, involved in many different kinds of businesses, complex ownership structures, lots of, SPVs and other kinds of, complicated ways of presenting the information or of having related party transactions. And you're not really sure, what's really going on fundamentally or organically within the company. And some people are just investing in those because they want to trade it. So I don't even call that investing. They're basically riding the wave, and they're taking advantage of the volatility and the skill of these companies to manipulate the news and get a rise in their stock price, even if it's only a temporary one.
Did you see the documentary? Because people actually went to China and they hired, Chinese translators and people who would work for them. And they actually went and got there was two set of books for some of these companies in the reverse merger. So there was the accurate Chinese financials. So the Chinese companies were actually scared to lie to the Chinese government regulators. And they were inflating the revenues and the other stuff, the other important key financials, they were inflating sometimes tenfold or more to the American investors.
Right. I have not seen the movie yet, but I'm very familiar with some of the people that were active in that regard, like Carson Block and others at the time. And I followed, some of those companies, wrote about some of them. AgFeed was a big fraud at that time that I wrote about. Again, all of the other, many of the other ones that did end up in litigation. But as you said, some of them are still going, or they've just sort of been reincarnated. That's what we were talking about earlier today about IGC, the stock that we mentioned. We wrote a story, and then it was the trading was suspended on NYSE American. They were delisted, but now I guess they're trading on the over the counter. And he was talking about the CEO was talking about maybe going to Canada. And so what happens with a lot of these companies is they sort of weather the storm and they kind of stay quiet for a little while, and then they reemerge, like a zombie, rises from the dead and becomes something else, shows up somewhere else. People are unawares, and we start the cycle all over again. So the problem is that the enforcement authorities don't take out bad actors once and for all.
Yeah, I agree. If they would have done that, things would be a lot better.
Yes.
Yeah, and it seems that they're basically either street hustlers or boiler room operations. So, they kind of, if something stops working, they shut it down completely, and then they just go on to the next fad.
When I was writing about a couple of the ICOs, in particular Kodak Coin, you saw that some of the people that were involved were just recycled microcap, fraud types. And I say that legitimately because some of the people had sanctions against them. One guy from a Canadian exchange that had been barred. Another guy had been barred from being an officer of a corporation in Germany. And then these people, form a new group, and they put something together, and they put a new shiny wrapper around it related to some other new fad or trend. And people need to do their due diligence. And if you don't bother to do that, then these people are going to keep recycling themselves, reinventing themselves, and live another day to do another scam.
Well, Francine, you're a wealth of information about accounting. And if I do see an article naming a company, if I did own the stock, I would immediately sell it that you wrote about.
If I write about you, you're in trouble. It's when people ask me, "Oh, what do you write about at MarketWatch?" and I say, "You don't want me to write about you because that means that there's something wrong."
Yes, it definitely looks that way, and you go into detail. So, and the funny thing I've learned from listening to some of these short sellers is they really know their stuff. I mean, I just started listening to a podcast about Herbalife and all that stuff. And, that no one's going to prison for fraud yet. But the more I hear about it, the crazier it is. And the stuff that I hear about Tesla is just nuts. And yet the stock price hasn't collapsed yet.
So I have a news story about Tesla coming out. It'll be out on Monday. And it's basically talking about all of the things that people were expressing concern about related to their latest earnings. And I sort of go into detail and say, here's where you can, explain it. Here's where, some people still have questions. So that's coming out on Monday on MarketWatch.
Very good. So if our listeners want to follow your work, how do they do so?
They can go to www.marketwatch.com and put my name in the search box.
And you also have a website, Read the Auditors, and you're on Twitter as well.
I am always on Twitter, and my website gets updated with references to stories that I write, places I go, places that I speak, and the presentations that I make.
Yes, and as I mentioned at the beginning of the interview, your excellent slides from your Grants Investment Conference presentation are on there, and I think you also did a podcast with Jim Grant as well. I did.
That was in June. And there've been a couple of others like you who've asked me to talk to them, or who've mentioned the presentation at Grants. I welcome emails, call or write. I like to talk about these things, and I'm glad to offer whatever I can to others that are researching in detail some of these issues.
Please like this video, share it with friends and family. And don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.